is Ross.
Hey Rob, thank you guys so much for having me. I'm going to get my screen share up. Let's see. Um, there we go. You guys can let me know if you're able to see my screen. Let's see.
Got it. Yep.
Rob,
Yep.
you guys can see that? It's the
Yes.
PowerPoint?
Yes.
All right, and let me see if I can find the questions tab so I can see when you guys chat. Okay. All right, guys. So, as Rob mentioned, I own WarriorTrading.com, and you can see right here, go to the next page. Warrior Trading has a day trading chat room. I'm trading there live every day from 9:30 to 11:30 a.m. I do trade a little bit in the afternoons, but mostly in the mornings. In the afternoons, I spend a lot of my time teaching and working with students. We have day trading courses, swing trading courses, and some specialized advanced scalping courses as well. What we're going to talk about today, though, is momentum trading, and in particular, momentum trading small caps, which is sort of one of the things that I really like to do, and it's really popular among our students because a lot of people will come to us with smaller accounts, and it's simply not feasible for them to trade the larger cap stocks. I mean, they might only be able to buy 75 shares or 100 shares, and you'd have to get multi-point moves to make any money, and those are hard to time and just not very easy for most beginner traders. So most new traders like to start with lower price stocks under $20, and so we specialize on trading those small caps. A couple special discounts for everyone here in the webinar. Our day trading course is $500 off, and all of our bundled courses that include chat room subscriptions and that sort of thing are 20% off. Okay, so you guys can check those out if you'd like. So in this webinar, we're going to teach you how to find small cap momentum stocks. All right, now a day trader is two things. You have to always remember this: a hunter of volatility and a manager of risk. We're looking for volatile markets. People sometimes will say, well, gosh, how are you doing? The markets are so volatile. We're doing great. Volatile markets are exactly what we want. We need stocks moving. If stocks aren't moving, we're not going to make money. So whether the markets are moving up or down, the volatility is what we need in order to have the range for potential profits. But all of those potential profits have to be offset with the understanding that every trade has risk. So managing risk is something that we talk about in detail in all of our trading courses. We're not going to talk about it too much today. I'm going to assume that you understand the risks involved with trading, and when we talk about specific profit-loss ratios and the amount that we risk per trade, some of that I'll assume that you have a basic understanding of those concepts. Okay, so today, as we talk about momentum trading, why is it important to understand momentum? Well, in order to be a profitable trader, at the end of the day, you're going to have to find momentum stocks. These are stocks that are moving. You don't trade stocks that are moving sideways. You won't make money trading them. So you need to find stocks that are moving either up or down. Any which way, just they need to be moving. Okay, and then you need to understand what makes a stock move. And of course, how to find entries in real time. It's one thing to look back on charts from last week or a month ago and say, oh, that would have been a great entry. But to find them in real time is obviously a critical skill for any trader. And if you can't do that, then you won't be able to pull the trigger and actually take positions. All right, you obviously have to manage your risk and understand your risk-reward ratios and your break-even points for any particular strategy that you're trading. And you also need to create a strategy based on your metrics, the time of day that you trade the best, the price range where you make the most money, stocks under 20 or above 20, whether you're more profitable to the long side or the short side. These are things that you need to understand about yourself so you can design your strategy around your own strengths. The strategies that we're going to talk about today, I've of course designed around my strengths, but I've also kept in mind some of the needs of new students, and this is a strategy that works really well for a lot of the new students in our day trading courses. Okay, so some of the critical skills for day trading: knowing how to manage risk, developing a trading strategy, and finding stocks to trade. Okay, it's pretty simple, but obviously very important. So those are the important skills. Now the important tools, a direct access broker like Lightspeed with hotkeys is very important. Good charting software built into most platforms like Lightspeed, but you can also get it standalone. Stock scanners, that's how we find the stocks that we're going to trade every day. So, imagine riding a $3,000 road bike in the sand. You're going to struggle, right? And it's not because you don't have an awesome bike. You've got an awesome bike, but you don't have the right equipment for your environment. Okay, so you're going to watch someone go by with, a Huffy with fat tires, and they're going to make it look easy. And it's not necessarily because they have a better piece of equipment. It's just that they have something that's suited properly for that task. Okay, so you have to use the right equipment. You have to use the right tools. If you try to, day trade on something on a broker that doesn't have hotkeys, you're really at a disadvantage. You need to have the best tools in order to see the success that you want as a trader. Okay, you make your life so much easier by using the right tools, and we have so many students that will come to us asking about the best brokers, the best charting software, the best scanners. This is all super, super important, but it's also going to be unique to the strategies that you're trading. Right? What works for me as a quick, high-paced day trader is not the same as what's going to work for someone who's swing trading or trading options or that sort of thing. So you have to be able to recognize your unique strategies and match the tools to that strategy. Okay, so I've always been a big fan of Trade Ideas. I know Trade Ideas integrates really well with Lightspeed. So out of the thousands of stocks that you could trade on any given day, how do you find ones worth trading? And that was my struggle as a new trader. I would just sit down in the morning and I really wouldn't know what to trade. There'd be stocks moving. I might look at something that I was familiar with, but it was really a little bit overwhelming. So using stock scanners will help you filter down to a small handful of stocks on any given day that are worth trading. Okay, so I filtered my scanners and trained them to only show me the type of stocks that I really like to trade. That way I cut out all the noise, I forget about all the junk, and focus in on the stocks that fit in with my strategy. And that helps reduce that sense of being overwhelmed with all of the potential stocks. Now, one of the strategies that we're going to talk about today is the gap and go strategy. But on a day like today where the overall market is gapping up, it can also be a little overwhelming because there's a lot of sympathy gaps. When the overall market gaps higher, there's a lot of stocks that will gap with it, and not necessarily because they have a lot of news or a really good catalyst. So there are days where even with the best scanners you can still feel a little overwhelmed, but they will certainly help narrow down the field of stocks that you can be watching. Okay, now I focus on, with all of our students, having them master one strategy. By mastering one strategy, you can tread water in the markets. Right? If you can get really good at one strategy, you can trade, at least break even or slightly profitable. And treading water is really important because it gives you the opportunity to spend more time in the market and to continue to learn and hone your skill and develop secondary strategies. Okay, but until you've mastered that one strategy, you don't really have anything. So you're not making money, you're not going to be consistent, you're just going to be floundering. And we really want people to, first get to treading water where they're not losing money, right? And then start to generate profits. Generally, with our new students, we see, two common struggles. The first struggle is poor accuracy, and that's a result of inexperience. And it's to be expected. It's nothing to be really that frustrated or ashamed of. Having poor accuracy, maybe trading on only a 30% success rate, is very common for a new student because they don't really know how to identify the best entries or how to avoid bear traps or bull traps or things like that. So they'll get into stuff that's really probably a more experienced trader would just pass up on, but being a little newer, they've got to go through that learning curve. So we want everyone going through that learning curve while they're trading in a simulated environment, trading in the demo accounts. And then once they've started to build up a little bit of consistency and starting to tread water, then that's often a good time for them to begin to transition to live trading and to start increasing size and branching out with some new strategies. Okay, but in order to be profitable, you absolutely need to be very focused and very disciplined, and you have to know when to sit on your hands. I just finished, well, I came to the end of a 56-day hot streak where I had 56 consecutive green days, and it ended on Friday. Friday I had a losing day, the first one since before Thanksgiving, and what I ended up doing on Friday was sort of ignoring what I always tell people, which is by, I think it was like 11 a.m., I was really only flat on the day. I was up like $30. And that's obviously, basically a break-even day. And I should have taken that as a cue from the market that I'm not on today. I'm either, I'm not having very good accuracy, I'm not seeing the market very well, or maybe the market is a little choppier than usual. But for whatever reason, take it as a sign that today's not your day to be aggressive. Today would be a good day to sit on your hands. And so many days during the hot streak, I did happily walk away with, a couple $100 profit or just a little bit above break even, knowing that that's fine. I'll live to trade another day. Not every day is going to be a big winner. For whatever reason on Friday, I pushed my luck a little bit and kept trading, and I ended up, giving back profit. And it was totally unnecessary. I was not being really aware of, one of the things that I teach and talk about almost every day, which is having the presence of mind to let the market tell you whether today's a good day or a bad day, rather than trying to force your, daily profits and your, to really aggressively trade your profit loss, your P&L. You have to trade what the market's willing to give you. Okay, so. Now, the strategy that we're going to talk about first, the gap and go strategy, this is a very simple strategy, and it's based on trading the big percentage movers, and it's really based on trading the stocks that are gapping up. Okay, this strategy does require hotkeys, quick reflexes, and good instincts. Your instincts will improve over time, and to pick up where I left off with the new students, so the most common struggle that new students have is poor accuracy, and the second one is an inability to manage risk well. A lot of students will overextend themselves, use their margin, be way too aggressive. So, and that's, again, an area where with discipline, with focus, you can rein yourself in to make good decisions. These are all things that come with experience, and you have to recognize that everyone has sort of an emotional capacity to trade the market. And as a new trader, it might only be an hour a day where you can sit and be hyper-focused on the market. For an experienced trader, they may be able to sit in the market for 5 hours straight, or maybe even longer. But for me, I like to trade from 9:30 to 11:30. That's when I can be the most focused and maintain my discipline, avoid making mistakes and getting overly aggressive. And knowing that about yourself is going to be really important for your long-term success. So back to the gap and go strategy. You will need good instincts, and those will get better over time. So the thought here on this strategy is to trade the stocks that are gapping up due to a catalyst. Oftentimes these stocks will open 10% or 20% higher than they close, which on the one hand, why would you buy a stock that's up 20%? Right? Well, then the other side of that is a lot of times these stocks had great news overnight. They open up 10, 20%, and then as soon as the market opens at 9:30, they shoot up even higher. So it's not uncommon to see a stock gap up 20% and then surge up another 20% out of the gates. It's a matter of understanding the type of stocks that are more likely or less likely to do that, and the type of catalysts that are likely to result in that type of reaction from the market. Okay, so the gap and go strategy, I trade it very exclusively at the open. You can't trade this strategy at 2 in the afternoon. We trade based on the overnight news. All right, so by 10:30, 11:30, the gappers are usually played out, and now it's time to look for other sources of momentum, whether it's breaking news or something like that. Okay, so the way I find all of my gappers is simply by using scanners. I look for the biggest percentage gap. It's a very simple scan. Looking for gappers gapping up at least 4 to 5%, and I prefer at least 100,000 shares in pre-market volume, although, I'm not against looking at something that has a little bit less volume as long as there's a good catalyst. On a day like today, as I said, with the overall market gapping up, there are lots of stocks gapping up in sympathy, but only trading like a couple hundred shares pre-market or maybe a couple thousand. And that's really indicative of a stock that's gapping in sympathy, not because it has its own catalyst. So it's a good idea to keep an eye on the overall market and just make sure you understand if we're seeing a big gap, then that's why the gap scanner might look the way it does. Okay, so this is a typical gap scan. My routine every morning is exactly the same. I get up and I look at my gap scan. I search for news on the top 3, 4, 5 gappers, and I look for the ones with the most volume. So on this day, CDTI, AVEO, and C-Trip, these were ones that I would have been fairly interested in. I'm interested in ones that are gapping to the downside as well, because I know that these are stocks that will be volatile, right? And most likely they have a reason for it. Okay, so some of these stocks had reported earnings overnight, which is a good catalyst. Others, like AVEO, it's a pharmaceutical company, so something out with that one could have been related to clinical trials or FDA approvals. Those are all good catalysts. CTI, Clean Diesel Technologies, probably some news there. So I'll look through these, and basically I look at the volume, want to see if there's some volume, and then I check the headline. Okay, so we scan for the gappers. We hunt for the catalyst. What is going to give this stock a reason to do something other than just trade sideways today? We already know it's gapping up. So instead of spending each morning going through the hundreds of headlines that came out on all these different stocks, I look at the stocks that are moving and then see what the headline is. Because sometimes there will be a headline that's really great and the market doesn't like it, doesn't react to it. So it's one of these things where I really try to avoid getting into fundamentals with this type of strategy, because you might think that something, that a catalyst seems really good, or that a company is going to be speaking at a conference or whatever it is, but let the market tell you if these stocks are going to be moving up or down. So I focus on the stocks that are already moving rather than try to anticipate based on fundamentals or something like that. Okay, so the first step, scanning, hunting for the catalyst, just looking for the news source. You can use StockTwits. There's a lot of free services out there. You can also just do the research inside the platform to see what the headlines are. Mark out the pre-market highs and the high of any pre-market flag. So if a stock has a pre-market high of $3, I'll mark out that high as an area of interest. And then what I'll do is I'll prepare an order. Pre-market, so as soon as the market opens, I'm ready to go. So basically that means just simply typing in the order entry window my share size, and all I have to do is click the send button, buy it. Okay, so as soon as the bell rings, I'm ready to go. Now I can also alternatively use my hotkeys to jump in as soon as one of these starts to pop up. So what I'll typically do with my gap and go watch list is have 4 on close watch. The most obvious gappers are usually the best ones. So those are going to be the 2 or 3 biggest percentage gappers, or the ones with the most volume. Those are typically the ones that are going to be the easiest to trade. Okay, so I get all my ideas from Trade Ideas. Those are my gap scans. Type in the ones that I like in the order entry window, and then I'm just waiting for the market to open. Now, it is important to choose the best stocks. There are times in the gap scan where I might see something like TVIX. say the market's gapping down, TVIX is gapping up. So understanding, when you see either an ETF or maybe a very thickly traded stock like Bank of America or Sprint or something like that, that those typically don't move as quickly. So one of the things that we will look for is a lower float. All right, now for people that aren't familiar with float, the float is the number of outstanding shares available to trade. So a stock, when they do their IPO, they release shares to the open market. Now, if they release 10 million shares, those are the shares that can be bought and sold by day traders like us. So their float is 10 million shares. Some companies have a float of 10 billion shares. And the obvious result is that a very big float means you need a ton of buying for the stock to make a big move. And a very small float means a stock can move very quickly without a lot of buying. So if you're looking for stocks that are going to be more volatile, you will inherently look for stocks that have a lower float. This is an example of a pretty decent pre-market flag. All right, we've got a move up to $20 pre-market, so a really nice gap from the close of about 14. This move up to $20, sideways consolidation around 18, 19. All right, so these are the levels that I would mark out: the pre-market high, the high of this mid pre-market flag consolidation, and the low of this little pullback. Now this is sort of a bad pre-market flag to me, because the stock gapped up to had a high of 220, and then it sold off the gap. So by the time the market's about to open, it's already well off the pre-market highs. This isn't something I would want to buy. I want to buy stocks that are consolidating as close to their pre-market highs as possible. All right, so as soon as the market opens, I've got my order ready to go, and I'm ready to jump in. Now, there's a few different ways to trade these gap and goes, a few different specific setups, and we're going to go through these here. All right, so the first one is the 1 minute opening range breakout. Sometimes the best gappers are too far away from the pre-market high to buy when the pre-market high breaks. So in that example where we had a pre-market high of $20, I would typically like to buy it over $20. But when it was looking to open around 19, that means if I got in at 20, I'm already chasing it up $1. So what I would do in that case, and that happens often, is I'll look at the first 1 minute candle and I'll let it close. The high of that first 1 minute candle would be my entry, and my stop would be the low of that first 1 minute candle. That's a 1 minute opening range breakout. Okay, that works really well for stocks that open below their pre-market high, and also for stocks that open at high of day. So say it opens at 20.05, and you're thinking, well, geez, I don't know if I want to chase this right out of the gates. I let that first 1 minute candle close. The second setup, simply buying the pre-market highs. Pre-market high is $20. That's where I'm getting in. Now, the only thing is that this requires a good pre-market flag. In the example of AVEO, you could see that pre-market flag, I mean, it had sold off all of pre-market. So we wouldn't buy pre-market highs on that one. But if you have a good pre-market flag, some consolidation below pre-market highs, then that can be a potential place to jump in, the break of pre-market highs. The third setup is simply buying the first pullback, and this is probably the one that requires the least amount of super quick reflexes, because the first pullback, this could be anywhere from 5 minutes into the day to 30 or 40 minutes into the day. So as soon as we get a 1 minute pullback, and this will take the form of a bull flag or maybe a flat top breakout, that would be my entry for some of these gap and goes. And if we have one, for instance, that opens at 20 and surges immediately to 21, you didn't really get a chance to get in without chasing it, so you simply wait for the first pullback. And that's when you can start looking at 5 minute and 15 minute opening range breakouts as well. Okay, so buying that first pullback, often the first and second pullbacks will get bought up. So anyone that missed that first move, right, they're going to see this as an opportunity to get in a strong stock. So they are the buyers of the first pullback. And then people that missed the first move and the second move, They see the second pullback, again, as an opportunity to get into a very strong stock. The second pullbacks often run, and then by the time we get the third pullback, usually these stocks are getting a little overdone and they can fade. So I only go for the first and second pullback. But I will trade the first and second pullback on the 1 minute chart, and then once we're into the third and fourth pullback on the 1 minute, I say I'm going to wait for a new 5 minute setup. So then I'll trade the first pullback on the 5 minute chart. So the first pullback on the 1 minute chart might be 7 candles into the day, 7 minutes into the day. And then the second pullback may be 15 candles into the day. And then we switch to the 5 minutes. So the first 5 minute pullback might be 3 or 4 candles into the day. So now you're 20 minutes into the day. So you can trade these multiple times on different time frames because all the traders trading on the 1 minute, once it's overdone, they're going to go to the 5 minute. Then you have the 5 minute traders who are going to trade those first and second pullbacks. All right. The next is the red to green move. Okay, so this is a pretty powerful setup. This is when the stock opens. Let's say it opens at $19, and you've got the pre-market high of 20. Opens at 19, and it immediately dips down to 18.50. So it goes red on the day. Red versus the open price. Okay, when these dip down like this, which is not uncommon when a stock gaps up, 20 or 30%, that they'll sell off a little bit at the open, people take profit. But watch this, because oftentimes they'll pull back and then they'll surge up, and when they break through that open price of whatever it was, in this case 19, they can make very quick surges. The only thing to be careful of is there is definitely that immediate sign of weakness because of the fact that it sold off at the open. And the strongest gappers don't do that. So if you get into a red to green setup and it doesn't immediately go green, that's usually when I just get out. So I'm a big advocate of the breakout or bailout. If it doesn't break out and work almost immediately, I get out of the trade. And this is something I apply to almost all the strategies I trade. In all my years of trading, the best setups work immediately. Okay, and the setups that I get into and they just sort of pause and hesitate, sometimes they end up working out, but more often than not, they don't. So if I get into something that I thought looked really good and it just goes sideways, whether it's a red to green or opening range breakout, I'll just get out, and I'll get out break even or for a small loss. There's no reason to let my max loss fire off. I don't have to trade where it's either a max loss or my profit target. It's totally okay to have lots of trades that are in between. Those are small wins, small losses, all while you wait for that next big setup. Okay, so we're going to go over a trade here that was a gap and go trade. This is OHGI. This was from last year. This was a particularly impressive one. But these are happening every single day, and you can look at them and pretty much every day. You can look at the stocks that are on the gap scan and look at how they trade. OHGI, it was gapping up. We had a pre-market high of 235, gapping up 16%, 38,000 shares of volume. We also had BIOC gapping up. Now, BIOC was gapping up with 900,000 shares of volume, which is actually a lot of volume pre-market, so much that it's almost starting to get a little crowded. I usually try to focus on stocks that are less than 500,000 shares of volume, because once they get over that, they just can have too many people trading them pre-market, where sometimes the best opportunities have already gone by. So OHGI, we look for the news. What's the catalyst? And there was a headline here that they were going to be supporting Alibaba's Alipay. All right, so that's a good headline for a small cap stock. Has a low float of 14 million shares. So I said I'm watching it long over 220. That was part of my watch list. The market opens, and we had the pre-market high of 236. Okay, now in this case, the market opened and it surged up immediately from 236 all the way up to 582. And this isn't on 15,000 shares of volume. This is on millions of shares of volume, tons and tons and tons of volume. You had over 800,000, over 1 million shares in the first 5 minutes. Okay, so these are very thickly traded, well-traded stocks, and it just made a huge move, 100% move. So a stock that was gapping up 16% and it suddenly explodes. All right, but to a certain extent, this was, this was a base hit. This was just a regular gap and go setup that happened to work out exceptionally well, and that's how it is sometimes. What you think will be a base hit ends up being a triple or a home run. So in this case, that first 1 minute candle is what I based my entry off of. Okay, so the first 1 minute candle, we opened at the pre-market high of 35, but then we just kind of squeezed. So you didn't really have that easy entry on the pre-market high break because it opened a little too high. All right, so it pulls back for a second, and on this I said, okay, I'm going to do the 1 minute opening range breakout with an entry at 69. Stop is 35. We go from 69 up to 3. That's my first target, is the whole dollar. Let's get up to the next whole dollar. And because we know that these small caps often trade with resistance around half dollars and whole dollars. So first target, let's see if we can get this up to the half dollar, or the whole dollar, 3. We get to 3, well, we also go to 350. And then we go almost up to 4. We pull back for a second, and this is just kind of an opportunity to kind of catch our breath and say, wow, that just really opened up. Is this going to be one of those ones that rolls over and sells off for the rest of the day, which sometimes happens, or is this going to be a sustained runner? So what I typically would do here is look at the first pullback. So this red candle forms the first pullback, and now the first candle to make a new high versus that red candle is going to be my entry. Okay, so whether this pulled back for 2 candles or just for 1 doesn't really matter. It's a pullback. So now I'm back in for the first candle to make a new high, and my new stop will be the first candle to make a new low. So I'm back in here holding until first candle to make a new low. So that's from about 350, 360 until 4. All right, and then again, this was the first pullback. Now we're going to go for the second pullback because there's people that missed the first pullback. They're just now seeing this stock hitting their scanners. They didn't do their pre-market research the way we were. They didn't look at the gap scan. So they're just kind of, seeing this hitting their scans, the high-low scanner, and jumping in a little late. So they're the ones buying up the second pullback. But I'm going to go ahead and add there also. So if I take 2,000 shares here, I might take 1,500 here and only 1,000 here, and maybe only 700 here. I'm going to decrease my risk as I get further away from the open because some of these can start to get really top heavy, and when they get top heavy and they get crowded, they can roll over very quickly. And you can see just as quickly as this went from 4 to 550, it came back down to 450. So you don't want to get on the wrong side of these trades that are very volatile. These are some of the most volatile trades in the market. I'm sure this was one of the biggest movers of the day, and this isn't the OTC. This is a listed stock, and it was probably one of the biggest movers of the day. All right, so this is a nice quick trade out of the gates. We asked our students in the room at that time who traded this with us, did you profit? 91% of our students were profitable on that trade for the ones that took it, and only 56 people took the trade. So that's actually the majority of our students ended up not taking the trade for whatever reason, but that's okay. Maybe it was for whatever reason they didn't want to take it. CDTI. All right, so this is another one. We had this one on the gap scanner. You can see it gapping up, 327,000 shares of volume. You've got AVEO up there again, a couple others. So what's the catalyst? I'm looking at catalysts on all of these. All of these are on my watch list. Not Con because it's over $20, but all the ones under 20 are on my watch list. All right, I think this was the day after OHGI because OHGI is right down here. So CDTI, what was the news catalyst? All right, you've got a headline on it, gapping up 14% with a 13 million share float. And I would consider any float under 50 million shares to be a very good low float. All right. So this one has a pre-market high of 251, which is great because that's right at the half dollar. I like to buy stocks at half dollars and whole dollars whenever possible. All right, so on this one, we actually got just a brief moment, really right at the open, where it was right under that pre-market high of 250. Okay, so we actually got a 1 minute opening range breakout, the first 1 minute candle to make a new high. Now we did get a dip here, but when I have a long bias, I'm not going to short these. I'm going to wait for the first candle to go up, and then that's where I get it. Got in at 240, and you get that nice move up to 338. That's a big move. That's a huge move on a $2 stock. From 239 to 338, that's awesome. All right, and again, asking our students, how did you do on this trade? 88% were successful. BLFS. Now this one, you can see the float is in yellow, 5.97 million share float. So this is a particularly low float stock, gapping up with 12,000 shares of volume. Now on any given day, this stock probably doesn't trade with any volume. It's not worth watching. But once or maybe twice a year, it'll come out with news. And that's the same with OHGI. Once or twice a year, it'll be in play. So as a day trader, I'm not trading Apple every single day. I'm going around the market to the stocks that have the most volatility and the most potential. So BLFS, you can see right here, this one, they've got another headline on it. It was a little bit of a messy pre-market flag. Not crazy about it. Okay, so initially it wasn't on the top of my list, but some of the other scanners I'm running are showing me stocks with momentum. Okay, so this was 931, and look at the 5-minute volume surge. 39,000% higher than average. That catches my attention. It's in yellow because I want it to catch my attention. Stock to its relative mentions, much higher than average. Okay, so low float, high volume, this is something to look at. You've got 596 times relative volume. Okay, and here we go. I'm looking at this when it popped up to 250 thinking, I'll take a stab over the $0.50. Why not? I get in at 250, it goes up to 450. Okay, again, these are just extremely explosive setups. Now, they're not always going to work. There are definitely times you'll get in at 250 and you get stopped out at 234. So you have to know what you're risking on all of these trades. In this case, 16 cents. For the potential, right, to go from 250 to 440, that's not bad for me, for my risk tolerance. Now, you never know when you're going to have a stock that goes up to, goes up 20% and then rolls over. But every now and then you'll have one that just runs and runs and runs. This was NDRM. This was about a year ago, from $8.80 all the way up to $19, $20. We had a couple recently, ATV, that was a big runner. Right now we're kind of in between big runners. And something that you'll notice is that when we have big momentum stocks, lots of other stocks will start running as sympathy runners. Okay, when you have a stock that makes a 100% move, you better believe that the next stock that gaps up 10% and starts to run out of the gates, everyone is going to jump in because they're thinking, this could be the next one. And more times than not, it won't be the next one. It'll gap up and it'll squeeze, but it'll have a little more momentum and a little more volume because people are looking for that next big runner. And the market is sort of cyclical like that, where once you have a big mover, you get a lot of sympathy runners, a lot of, will this be the next, XYZ, whatever. And then you go through a period like we're in right now where things get a little bit slower, waiting for, the next stock, basically to gap up, with a really, really good catalyst. So a couple that we had in the past, you can look on the charts. We had Lake. They make biohazard suits, so during the whole Ebola stuff, that one was crazy. DGLY, they make the body cameras that police officers wear, and so after what happened in Ferguson, there was some thought that maybe maybe it would become a requirement that all police officers wear them. And so we can look at the chart here. Just back out of this for a second. Oops. So DGLY. See if I can pull this up. Well, I'll give it a second. But in any case, we'll see these that just make phenomenal moves. They make huge moves. And so for the next few weeks, any stock that starts to pop up will get that little extra boost. This could be the next XYZ. All right, so NDRM. Here's a good example of a gap and go doing a red to green move. A nice gap up, PAC-B, and then a sell-off. And on this one I said, let's look at the first candle to make a new high. And then you got that sell-off down to 450 and then that squeeze back up through 5. And you got a couple of setups here. So you have the first red to green gap and go setup, and then you have a momentum setup a little bit later in the day. Now, at a certain point in the day, we're past the gap and go time of day. So now we need a fresh catalyst. AXS, this was a momentum stock that had news in the middle of the day. You can see at 12:30, right after 12:30, a big volume spike. Okay, so this was breaking news in the middle of the day. This spikes up from whatever, 55 to 56, goes sideways, and then moves from 55 to 57. And then again, this is your first 5-minute pullback, your first 5-minute flag for an entry over 57, 57 to 58 to 59. So this strategy of trading momentum, right, whether you're trading momentum in the sense of a gapper, which I sort of subcategorize as a gap and go setup, where you're trading momentum at midday breaking news, these are stocks that have a lot of potential, and it's something you'll see on all price ranges, but a lot of our students prefer trading some of the lower price stocks. The higher price stocks like AXS, they trade with bigger ranges, bigger spreads, and they are, they have the potential, certainly with 3,000 shares to, make or break your month. And traders with larger accounts with skill will often branch out to some of these higher price momentum names, because catching a 4-point runner with some size can be, really nice. But note that these are some of the more difficult ones to trade. Okay, so in addition to the stocks that we have on our watch list as gap and go setups, right, those we're trading based on overnight news. So once the overnight news has been circulated and traded, we have to wait for fresh news, right? And that's when we start to look at the headlines coming out in the middle of the day. Today we had news on WATT, which squeezed from $5.60 to nearly $7 in 10 minutes. And that was in response to a breaking news headline. That was a quick 20% move. That offered profit potential if you were fast enough to spot the opportunity. Okay, so there are almost always opportunities throughout the day. It's just a matter of, whether you have the discipline to stick out the day, and also if you have the ability to understand which headlines and which setups are worth trading and which ones are going to be, false moves. Because you also have headlines where stocks will surge up and then they'll quickly reverse, and that's definitely not uncommon. Let's see. Show you WATT here. You can see that big spike, right? Headline came out, and this ended up, being kind of a funny headline, because the headline was that they signed an exclusive agreement with Apple with a link to an article. When you read the article was totally unconfirmed. It was just sort of an opinion that they would be a good match. And so we got this quick squeeze, and then we got a retracement. But I guess as the day has gone on, people maybe have done some more research, and for whatever reason, they do want to buy this up. Monsanto, this one had news today in the middle of the day. Look at this. News comes out. So you don't always want to jump in and short news, because in this case, drops down and then comes right back up and even higher than it was before the halt, or before the news, probably because people that were short decided to cover for a loss. So you have to learn to understand which setups are worth trading and which ones are not. Okay, so my momentum trading strategy, this is really what I will start doing anytime past 10:30 or 11. Once the gap and goes are kind of done, I move on to trading momentum, stocks that are either hitting my high of day scanner or where I hear breaking news. This is my focus. I focus on trading stocks that are either at highs or at lows. I don't like to trade mid-range. I know a lot of traders really are happy to trade mid-range and can do it really well. I prefer to trade at the extremes, the range ends. So stocks that are either at highs or at lows. And I'll trade them both for continuation and for reversals. Although today we're going to talk primarily about continuation and momentum. Okay, so these momentum stocks, we have a gap and go set up in the morning, like that NDRM that we were looking at, and it ends up running to $20. So at a certain point, it's no longer a gap and go setup. Now it's just momentum. It's just strong. Okay, so we'll still apply the same strategies. These are going to be the first pullback, the second pullback, possibly looking for opening range breakouts if, you've got a 60-minute opening range or something like that. Typically, the flag patterns I'm going to look at are bull flags and then flat top breakouts, because those provide really clear and obvious entries for me that I can understand. I look at the chart and it's obvious. If it goes above this price, that's in breakout territory. Okay, now oftentimes these big momentum midday runners will be totally under the radar. They weren't on the gap scan, they weren't on the watch list, but the market opens and volume starts to pour in. So when I see these stocks hitting my high day scanner, I'll do a quick review. I look at from the technical perspective, what's the float? Do we have a low float with big volume? If we do, then it's something that I might just jump into as soon as I look at the chart and recognize I can get a good entry. If I'm a little unsure, then I might go ahead and do some quick research, see if I can find if there is a headline. But one of the things is you let the market tell you what's hot, and sometimes something will run without a headline. There's not really a good news piece or a good reason, and they run 30–40%. And sometimes in the middle of the day, a company will come out and say there's no news to account for this move. So why is the stock moving 20–30%? Well, it's hitting people's high day scanners. People see it moving. They're jumping in on a pullback, and next thing you know, it's up 20%. So the market can be a little bit irrational, and it can totally go against all the fundamentals of a company. A lot of these stocks, especially the small caps, can make 20, 30, 40% moves. And the reality is the company may not have very good financials, may not be a good long-term investment. But as a day trade, it might be perfect for us, for what we're looking for. So you have to understand the lens that we're looking at the market through. All right, now the key to finding momentum midday, just like the gap scan, it's going to be midday scanners. So we're going to be looking through and seeing which stocks are hitting those scanners, the surging up scanners. We're hunters of volatility. We're looking for volume, looking for stocks that are moving. At any given time, there is a stock in the market that has the most relative volume of all the stocks. So that's the one I'm going to look at, and I'm going to try to understand what's the cause. So it can be a stock that in the middle of the day is selling off, or a stock that in the middle of the day is squeezing up. There's all types of different catalysts that can cause midday momentum. But our job is to look for the volume, find the volatility, and then look for those safe entries. So midday, I'm a lot more cautious about buying high-day breakouts. I'd usually like to buy the first pullback or get in close to a support level. And a support level in this sense will be the bottom of a pullback. So a pullback maybe to a moving average like the 9 moving average or the 20 moving average. You can have a stock that pulls back to the moving average and is still very close to high of day, but isn't just quite as extended. So that'll provide for me a safer opportunity to get an entry, and then if the position starts to work, I can always add shares for the high of day break. Right? But if I wait for the high of day break and then add, anyone that bought on the pullback might decide to sell at the high of day spot. So now you kind of have this mix of churn that happens where you've got people buying and selling, and that's not really what you want for a breakout. You just want tons of buying. So that's where midday momentum can get a little trickier, and why a lot of traders like to just trade the morning, trade until noontime, and then call it a day, and not be overly aggressive in the afternoon. Historically, I have always done better trading in the mornings. If I couldn't trade in the afternoons, if the market decided to start closing at noontime, it wouldn't be a problem for me. I focus on trading in the morning because that's when I'm the most profitable, and that's when we have the most volume in the market on almost any given day. There are certain stocks that will peak on volume around noontime or midday, but typically the market is the most active in the morning, and that is the easiest time for me to be a day trader. All right, now remember, of course, the first pullback, the second pullback, these are almost always bought up when you have a strong momentum name. So looking for these pullbacks, you can see it right here, this one that we looked at before on AKS. This is a nice orderly pullback. you have 2, 4, 6, 7 green candles, 2 red candles, right under a whole dollar, so you can get that whole dollar entry. So my entry would be at 57. I almost always have my stop at 89, 10-cent stop with a whole dollar entry, 10-cent stop with a half dollar entry. So I'm in at 57 with a stop at 90, or I'm in at 50 with a stop at 40. And more often than not, when I get in these, they just go. Now, if I got in this at 57, it pops up to 57.10, drops down to 90, stops me out, and then it runs. Will I be annoyed? Yeah, I might be annoyed, but stopping out for me is the right thing to do, because there are also times where you'll get a false break where something squeezes up to 57.10, and then that'll be high a day, and it turns around from there. So I always enter trades knowing what my stop is, knowing how much I'm risking. It's really important that you understand that for yourself also. CTRV, this is one that had this moving average pullback, consolidation, and this also lined up with a break over the half dollar at 550. So as soon as we got that break over 550, there's a possible entry there, stop at 540. And on this one, we moved all the way up to 634, which was really good. Now in this case here, you can see the 5-minute chart, and then you see the 1 minute. So we got this pullback, and then which is 0.1, and then we got 0.2, which was a high. And then we got 0.3, which was a double bottom versus 1. All right, so this is kind of the moment of truth. Is the stock going to go down, up, and then make a lower low? Or right here, are we going to go break 2? So at this point here, you know the next move is either going to break number 2 here or number 3. So for a long bias trader, seeing this break over 45, the high of 2, that tells me the trend is moving back to the upside. That coincides with a half dollar of 550. So you kind of have two setups there, which really add strength to jumping in at 45 in anticipation for the break of 550. And look at the volume we have. So this volume is the result of thousands of day traders seeing the same opportunity. So that's why we want to look at obvious setups. An obvious setup will be recognized by thousands and thousands of traders, whereas an obscure setup may not be recognized by very many people. All right, now you can see here another example of the first pullback. This is the first pullback after the break to new highs. So this pullback, once the stock really started to get underway, you got that nice breakout. The red to green move was okay as well, but a nice clean, orderly pullbacks are usually the easiest to trade. This long consolidation, look at this, 55, right under 55, and then when it breaks, we go straight to 55.40. I mean, a nice quick break happens on stocks of all price ranges. But on a stock priced at $6, if you have a small account, it's easier to be more aggressive than on a $55 stock. So that's why a lot of our students like these under $10 setups. But you know, if you filter the setups that you're going to look for to only be under $20, you're going to trade less than someone who can trade all the way up to $100. Right? There's only so many flat top breakouts in a day. So if you know that's your setup, but you won't trade anything higher than 20, it does mean you'll probably be trading a little bit less. And that's fine. Trading less is not a bad thing, especially if you have a small account and you need to really think about each trade that you take. Another momentum name, right? From 594 all the way up to 938. These are some big moves. Notice the cleanliness of these charts. The first pullback, the second pullback, nice clean patterns. Okay, so those are the bull flags looking really good. Usually looking for 2 to 3 candles of pullback, form the bull flag, the first candle to make a new high, that's my entry. I often look at this surging up scanner. This tells me at any given moment which stock has the most volume in the last 5 minutes. So at any time of the day I can look at this and see which stock has the most volume. Sometimes there's nothing on here higher than 500. 500 is my minimum. So, you know, that'll tell me there's nothing in the market moving right now that I would like. Other times you have something like this, and this is something that I would go and take a closer look at to understand why it has 33,000 times the average volume for the last 5-minute period. This is possible that it's going to set up for a nice bull flag or a nice reversal. All right, Zaza, this is another one off the surging up scanner. 3,900 times regular volume for a 5-minute period. This big push, light volume consolidation during the pullback on the breakout over 330. Volume comes back in, traders recognizing that as an opportunity to jump in. This is not really a gapper, it was just a stock that was strong out of the gates. Another momentum example showing you the pullback. First pullback, second pullback, third pullback, no good. First pullback on a little bit of a higher price stock. This was one that was pretty active at one point. So my exit indicators for me, whether I'm trading a gapper or a momentum stock, I almost always sell half when I reach 15 to 20 cents of profit. Sometimes when I reach 10 cents if it's a stock that's not moving very quickly. I sell half and I put the stop on the rest at break even. By doing that, anytime I'm in a stock that goes up 10 to 15 cents, I know I'm going to walk away at least with a small profit, because the rest, if I stop out break even, at least I sold half for a profit. By doing that, I'm able to trade with a high percentage of success. So, which for me is 70%, and I consider that to be pretty high. I'm sure there are traders that trade higher than that, but 70% for me is pretty good. Yesterday and today, both days I was trading above that. Today I think I traded 10 names and was right on 8 out of the 10. Yesterday I traded 9 names and I was right on 9 out of the 10, or 8 out of the 9. I only had one loser yesterday. So, accuracy is important. Consistency, super important. That's how you build confidence. Now, the type of trader you are will be dictated by your risk tolerance and your personality. I look for as consistent as I can for consistent profits. Now, when we're talking about consistent profits out of the stock market, that's hard to find. The market is volatile. The market goes up and down. So I've had to adopt a strategy of selling half when I'm up a little bit, adjusting my stop to break even, and selling the rest into the continued move. And that means sometimes a stock will go a point and I sold half for 20 cents. But other times stocks go up 20 cents and I sell half and they come back down, and instead of that being a loss, it ends up being a small winner. So I have lots of small winners, lots of small losers, and occasionally a big winner. My biggest loss in the last 58 or 59 days of trading was $1,000. That's my max loss. And my biggest winner was $2,500. So I set hard stops on all my trades, hard mental stops that $1,000 is max loss. I only had one trade that was that bad. And the second worst one I think was $600 loss. So I'm able to hit my $500 daily goal without being overly aggressive. But you have to understand exit indicators. So you can see here on this 5-minute chart, this green arrow, this represents a reversal indicator that's a custom algorithm that we wrote for eSignal. So when we get this sell-off and then we get this indicator, this obviously is a reversal indicator. This is a place where I would certainly cover up my short, and I would be looking at this for a long for a bottom bounce. So I designed this indicator specifically for getting into reversals, shorting strong stocks and buying weak stocks. But if I'm in a stock to the long side and I see this reversal indicator popping up, I'm going to be mindful of the fact that this stock is getting very extended. Okay, so for me, the biggest reversal or the biggest exit indicator is if I'm at a loss. I have a 10-cent, usually 10-15 cent stop on trades. So if I get in something that drops 10, 15 cents, 20 cents, I'm out. I take the loss. Breakout or bailout. If I'm up 15, 20 cents, I sell half, adjust the stop to break even. If I'm up another 15, 20 cents, I sell another quarter, adjust my stop to 20 cents in the profit. If I'm up 30, 40 cents, I scale out. Sometimes I scale out until I only have a couple hundred shares left, right? And then that last 100 shares, maybe I'll hold it for 1.5 points or 2 points. I had a stock where I got a 10-point bounce on it. Now that 10 points, I was only holding a couple hundred shares, but it was a really big move, and I kept a little piece for that bigger move because of scaling. And this is another really good reason to trade with Lightspeed, because you'll get a much better commission rate scaling, especially if you're on a per share structure, than you would at a firm that charges you, a really high amount for every trade. For me, I could easily generate $35,000 to $40,000 in commissions each year, and Lightspeed is a very, very affordable place to trade. If you're trading at a place that's $15 per trade, for me that would be over $100,000 in commissions a year. So if you're a very active trader, it makes sense to use the right tools. It's really important to know that. All right, so what have we talked about today? We've talked about how to trade the gappers and how to find the momentum. This is what I'm doing every single day in our chat room at Warrior Trading. So we'd love to have you guys check us out. If you're interested in any of our courses, you're welcome to check those out as well. We have classes on swing trading and day trading. A couple of the special discounts for today: the day trade course for $9.99 and 20% off our trading course bundles. All right, and anyone with questions, you're welcome to email me, ross@warriortrading.com. All right, so I'll see if I can answer some of the questions in the room here. Let's see.
Ross, some people were wondering on your scanners themselves, are those custom Trade Idea scanners or just predefined scanners provided by Trade Ideas?
Yeah, so that's a great question. These are all custom scans that I've developed over the years of trading, looking for specifically stocks that fit into the strategies that I trade. So we've got momentum up on the top. These are under 10, and these are sort of all price ranges for high day momentum. And then these are reversal scanners and parabolic movers, which can be good for timing a reversal. Now, sometimes you see a stock surging up on the reversal scanner, and you can trade it to the long side before it's a short. But these are the scanners that I have, and these are looking for the range extremes. All right. Now, over the last 56 days of my hot streak, my average position size was only 1,500 shares. My average dollar size was only $11,000 per trade. I wasn't being super, super aggressive. I don't need to be aggressive. My average profit was $534 a day. And that was trading 9:30 to 11:30 momentum.
Great, guys. Do we have other questions for Ross here?
So the question about the fees eating up your profits, I mean, obviously, if you trade with a smaller account, fees are going to be a proportionally higher percentage of your profits. If I was trading with a small account, I wouldn't change my strategy. I would just acknowledge that during the period where my account was smaller, that the fees proportionally are a little bit higher, but that's something that you deal with as a new trader with a small account. But if you're trading per share, then if you have a per share commission structure and you're trading 100 shares of a $50 stock, then per share you're not going to be really spending that much on commissions. It's not going to be that bad. So I mean, like I said, my average position size was only $11,000, so it's not really an issue of not being capitalized. It's just that you have if you want to be an active trader, you've got the PDT restrictions, so you would need the $25,000 minimum in order to trade 10 times a day or whatever you might want. But you certainly wouldn't need the amount of buying power that comes with that, but you would need that balance for the PDT rules. Yeah, sure thing. I'm happy to be here.
Yes, thanks, Ross. Everyone, please feel free to email Ross directly, ross@warriortrading.com. You certainly can email Lightspeed as well, sales@lightspeed.com for new account info, or service@lightspeed.com for any additional assistance on your existing account. So, this recording is going to be posted to our website. It's going to be available in a couple days, so you'll be able to review it again. And then just reach out to Ross. He'd be happy to discuss anything. Maybe you guys would be interested in joining his program or his chat room, so definitely reach out to see what he has to offer and see if that could work for you. We thank Ross for joining us very much. We hope to have him back again in the near future. So let's... hopefully everyone look for that, and we'll try to get that scheduled shortly. So I think that's basically going to wrap it up, and everyone else just send us the questions, and we'll try to get you some answers. So thanks, Ross. Have a great night, everyone. Thank you for attending, and we'll be in touch. Thank you.
Thanks, guys.